Afternoon, Dima. Good to see you, buddy.
Hello, how's it going?
You ready to get this webinar going?
Yep.
All right, let's
You
start.
have to launch.
We just launched it on Zoom. Thanks for joining everyone tonight. Tonight's webinar is on option strategy benchmarks. And I think Market Chameleon is basically the main entity that puts out these benchmarks. Is that correct, D?
I think so, as far as I know. But, even before we get there, I think I just want to talk about benchmarks, kind of go over why they're important, why we use them. So we'll do that first. I think that's probably more important than just looking at the benchmarks.
All right, well, let's wait. We got people rolling in. I know we had hundreds of people register, so let's give it a few minutes.
Okay.
You're on. We're live on YouTube as well as Zoom. If you're in Zoom, please put it in any questions you have in the Q&A, and we will try to get to them. If you're on YouTube Live, put it in the chat. Let's make sure everyone can hear us. Let us know where you're from in the chat. My name is Will McBride. I am one of the co-founders with the King Chameleon, Dimitri Pargamonic of Market Chameleon. I am from Washington Crossing, PA. And D, where are you from again?
Philadelphia,
PA, the city of brotherly love. Love that town. Are they opening up restaurants yet in Philly?
Yeah, no, they are. We are open. I think at least 25%. It might be even more now, but definitely they've been opening up.
That's awesome. We have someone from
Dallas, around your. What's that?
We have someone from Dallas, Texas, Reno, Nevada. You know what? They closed, but they were always serving. It seemed like any restaurant that had like a following, they were always doing something. Whether it was
had some
outdoor, small indoor, whatever they could do to get money flowing through the door, they were doing.
Yep.
While we're waiting for people to still join, why don't we do the disclaimer real quick?
Okay. So before we get started, everyone, keep in mind, Will and I and Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, contact your broker. That's what they're there for, to help provide you with guidance and answer your questions. So there's the disclaimer.
Excellent. So we're about 3 minutes in. You want to get started?
Sure. All right, let me share my screen real quick. I have to, I think, kick you out.
Yep, perfect.
How's that look?
Great.
Okay. And I think what I want to do is really just kind of explain in finance why we use benchmarks. It's very important. You're going to see benchmarks everywhere. We use benchmarks everywhere. And a benchmark is, you probably use it even without knowing, almost on a daily basis. And I'll give you an example. Like if you go to a grocery store and you're buying apples, you approximately know what that apple should cost. What's an apple cost? Well, like 75 cents an apple, something like that.
Probably.
So you approximately know it's around there. It could go up a little bit, down a little bit. But if you went into a grocery store and saw an apple for sale for like a penny or for $50, you know something is off, right? Something is wrong. That's either way too cheap or way too high. And because you already have that benchmark in your mind from doing it all the time. And that's kind of the thing we start using in financial products, financial securities. We use benchmarks because the prices are always moving around. And we kind of need benchmarks to give ourselves a frame of reference. And I'll give you another example that you probably most commonly see in securities, financial securities, is here's SPY. We know today it was down $3.08%. Well, that's benchmarked against yesterday's close, right? So that's an easy one. We just see what it changed. So that's kind of an important thing to know, that today it's lower than yesterday. Just like right now, I'm looking at after hours. Well, after hours, it's up 0.1, up 29 cents. That's benchmarked to the close. So that just tells me really quickly, instead of just looking at the price, that it's doing better than the close. So now I know it's up after hours and by how much. So that's a very simple just example of just benchmarking the price. Of course, we could benchmark it 52-week high, 52-week low, how far away we are from there, moving averages. Very common thing to do is use benchmarks. Now, the other thing with financial assets is that besides the price, benchmarking the price, you kind of have to get a sense of what are we getting for that price. So if you kind of look up, did you ever read one of the famous quotes that Warren Buffett, I think, says? Maybe you could even find it. I think it's something like, price is what you pay and value is what you get. Okay. And that's important when we come and start analyzing financial instruments. I mean, it's very important. My son, he's 12 years old. He got into this show, Shark Tank. Have you ever seen that show, Will?
Yeah, love that.
And you're going to hear something that they always have in common when somebody pitches them the idea and they want to sell their business, right? They want to sell shares in their business. And you'll hear them say something which is very common in the financial industry, but you don't usually hear other people outside the profession saying, and they'll say, well, that's a high valuation. That's a low value. It's either a high valuation. What are your profits? How much do you sell it for? How much does it cost you to make? What are your profits at the end? And that's because if you're paying a price, if they're asking, well, I want $100,000 for 10% of my company, or I want this amount, well, that's a price. But you want to know, what am I getting in return, right? So imagine this. You're looking at stock prices. The stock price is going up. So you think, I have to buy it. The stock price is going down. You think you have to sell it. But this entire time, you don't even know, what am I getting for what I'm buying and selling? So imagine like you walk into a grocery store and they hand you a bag of goodies, but they don't tell you what's inside them. They just say, oh, this handed bag of goodies, it's $10. Now it's $15. It's $20. It's going up. You got to buy it. So you go in and you buy it because the prices are going up. And then you could look inside it and maybe you got a great deal. Maybe you bought some for $20. You look inside and you're like, oh my God, I always wanted this thing. I would have paid $50 for it, right? That's the value you got. The price is what you got paid. The value is what you got. Or you could open it up and say, well, I just bought this bag of goodies for $20, but then I look inside it and there's like 2 apples in there. That's worth $1.50. So that's the difference between first, price and valuation. I want to hit on valuation, and then we're going to go into benchmarks. So a couple of things going forward as we learn more about fundamentals. We're going to learn about valuation models because we want to see what are we actually getting for the price we're paying. We're going to also learn about benchmarks, and then we're going to also learn about statistical odds. What are our potential reward? What are our potential risk? Is it a good risk to take? Okay, those are all very important concepts. So let's take a look at first just valuation. And I'll take a look at SPY. But what do I mean by valuation of financial instrument? Well, when you buy an investment, right? Let's do an example. I bought a rental property for $100,000, right? So I bought a house for $100,000. Well, what do I get for it? Well, if I'm collecting rent, let's assume I collect $10,000 in rent every year, right? That's my rent. Well, that's what I'm getting for it. That's part of my value. I get the right to that rent. I bought it for $100,000. I get $10,000 in rent. And how much did I pay for that value? Well, I paid 10 times. It's 10 times what I'm receiving in rent, right? If I get $10,000 and I paid $100,000 for it, I just paid 10 times the rent I'm receiving. Okay, if I paid $200,000 for it, I would pay 20 times. All right, so that's the price I paid. The value I'm getting is that rent every year. Right. I'm also getting some other things for it. I'm getting the actual house. I got the land, so I have the rights to that as well, right? I could, if my tenant moves out, I could live in it, or I could, break down the place, put it up. But those are the values that you are receiving for the price you're paying. And that becomes important, and actually, like right now, I don't know if you see that's kind of even being like, a lot of it is being debated even because we're seeing a high valuation, stocks running away. But that does become important, what you're getting, because you got to feel comfortable what you're buying, you're getting the value for it. So let's just take a look now at SPY, what we're talking about. Okay. So in SPY, I see this price. What am I getting for it? So when you buy a company, when you invest in a stock, right, part of what you're getting is the earnings that the company is capable of making per year, right? So that's just like if you bought a house, you get the rent. Part of it is you're getting the earnings, because theoretically you could buy all the stock, right? Take over the entire company, and you get to keep all the earnings that company can make. So how much are we paying more? What are we paying for those earnings? That's an important question, right? Is it worth it? So right here, we're going to look at our first valuation, and then we're going to take a look at another benchmark, where we are versus a historical benchmark. So right now, this PE, this is price to earnings. Probably most of you guys already heard of it. PE ratio, price to earnings ratio. And what this is saying that if we took the total market cap of all the stocks in the SPY, S&P 500, right? We just bought them all, total market cap, and divided it by the total amount of earnings that they make, right? Right now, we're paying 35.89 times its earnings. In other words, if all the S&P 500 stocks, their earnings remained exactly the same year after year, it would take us 35 years to make back our money from the earnings. Well, then is that high or low? Now, of course, you could just subjectively say, well, that's too high, right? But what are usually people, that's why we kind of take a look at a benchmark and say, well, where does it usually trade? How far away? And we see that on a 3-year average, it's around 28. 5-year average, it's around 27. So we see here that it's right now, when we're talking about valuations are high, right now we got to frame how high are they. So we see it's like, what is that, 25%, something like that, above where the average was historically. All right, so now I'm using a benchmark to see, well, how far above are we? Let me know, Will, if this.
I'll let you know if there are any questions.
If there are any questions. Of course, we could go down further. This is price to sales. So if we just care about just the sales, just the revenue, that's also a ratio here, 2.8 versus historical 2.63. We also get the cash, right? Not only do you get the earnings of the company, but theoretically, if you bought all the stock, right, the company is yours, you could sweep the cash, right? That's on the book. It's your company. You could sweep that cash. So how much are we paying over the cash sitting at the company? That's this ratio. What about book value? Well, a book value is, what if I just broke up the company? So I bought the company, and maybe I don't care about its earnings. I don't care about, I don't care about running. I just want to take the total assets, sell them, pay off all the debt, and keep what's left. And that's what corporate raiders used to do. You ever see the movie Pretty Woman? Well,
yeah, love that movie.
That's what he was doing. Right. That's what he was doing, because the price was below the book value. Right. So if the price is below the book value, you could just go out there, buy the entire company, sell every asset, pay off every debt, and keep the rest. So if there's an arbitrage there, you could also do that. So then we take a look at, well, how far is the price above the book value or its breakup value? So that's 12.94 right now. And usually you'll see it trading at a premium, especially to compensate if you're getting a lot of earnings there, right? Because then you could buy it for earnings. I'm going to just go do these last couple, and then we'll look at more benchmarks. But there's a reason, why these are important, because right now what I'm showing you is a benchmark versus historical. Now we're going to do a different type of benchmark, and I'm going to compare two different assets. So here, another benchmark that is important, and you probably heard these on Shark Tank. You ever hear? I think I was watching Shark Tank yesterday with my son, and they would say, like, I think there are two guys, they're pitching an idea, they're doing like these party planning things. They're making like, $2 million per party or something like that. And so some of the Shark Tank, I think there are 3 Shark Tanks that bid on it, and they're referencing the EBIT, the earnings before interest and taxes. In other words, it's how much is your company, if you bought the company, well, how much are you earning before you pay the interest and taxes, right? Because here the PE, that's your net earnings, but theoretically, maybe you could pay off some of the debt. You were not going to even have to pay that interest, and taxes you have to pay anyway. So maybe, just to see how much are you earning from that company before you even pay those taxes and interest. So that's price to EBIT, right? So that's here 26.6. We see that historically 21.35 is our historical benchmark, 3-year average. So we see how far we stretched from that historical average, in the mid, a little bit higher than the mid 20, over 25%, right? Price to EBITDA, that's important as well, because that's your earnings before interest, taxes, depreciation, amortization. That's 17.9 versus 14.8. And this one's like one of my favorite ones, price to operating income. And operating income is the income you're generating from your core business. And the thing is, when you're looking at net earnings, a lot of times that's muffled because, you got a lot of stuff going on. Companies have investments in stocks, they have investments in real estate. They could sell that, make money. They could sell it, lose money. So they're getting other sources of income, but the operating income is just income that's directly related to your core business. Like eBay has a business that, they have a website and they charge fees for matching up transactions. So how much money are they making? That's the core business. That's what you want. Everything else, if they sold assets here and there, made money, take that out of there. So that's price to operating income. So if right now we're paying 25.61, meaning that if SPY operating income does not grow at all, it stays exactly the same. It'll take us 25 years to recover the cost of, what we're paying. That compares to a 3-year average of 21.54. So you could see how the valuations right now are higher than the historical averages. And here's the point why we're looking at these is if we're looking at it from the perspective of how much money am I earning, right? The higher the PE, the longer it'll take you to make that money back. So for example, if I bought a piece of real estate for $100,000 and I got $10,000 in rent every year, it'll take me 10 years to make back my money, right? And then I got it for free. But if I pay $200,000 for that same property, it'll take me 20 years to make that money back. You understand? So I hope people kind of understand it, and then we're using it. Well, historically, where did it trade at, right? So that's my benchmark, the 3-year. That's where we are now, and that's how far away. So what we're doing here, the lesson is we need to convert this price into some kind of valuation of what are we getting for the price, right? Because
so that price SPY, it looks like it's trading almost 25% above its 5-year average. Is that correct? That P to operating income, you were looking at it? Price to operating income? The price to well, I was looking at price to operating income. But
okay, yeah. Price to operating, right. So you would So in other words, either the earnings have to accelerate, they have to catch up. So you're saying that, well, yeah, I was receiving $10,000 in rent for this house that I bought, but I think next year the rent's going to be $12,000, the year after 14. So then you would be willing to pay a higher multiple because you're like, well, it's going to grow really fast. There's a high demand. I'll pay more, right? That's your expectation of the future. So that's one thing we didn't get into. We're just kind of looking at the trailing 12 months, but we will get into, well, what about the growth? It's not expected to stay the same. It's expected to grow. We got to price that in. But the important things, I think the takeaway here is we kind of need to think of stocks in terms of valuations and then benchmark those, right? Because it doesn't tell me much that, okay, well, the stock last year was this much and it's this much, because I might be getting more value for a higher price because the earnings grew by a lot. Okay, so that's an important concept. So let me do another benchmark. So this one, I benchmark the valuation against itself. This is historically where it is, where it was. It's here now. So we see relative to where it usually trades, it's higher. In other words, like if for a house that makes $10,000 in rent, it usually is $100,000. That's what people were buying and selling it for. Today, it's $150,000, but the rent is still $10,000. So that means you stretch that valuation. Okay, so it's just comparing it to itself. But let's compare it to a different product. We could compare SP, something like, let's say Google, right? And I'll take a look at Google's actually, before I compare the Google's valuations, we could compare Google's, let's say, just profit margins. Here's another benchmark, right? So here's how I'm using a benchmark. So I see maybe Google is trading at so here, Google's PE is 35.8, which we already determined that's the same as SPY, right? So SPY and Google, same. We're basically paying the same price for the amount of earnings that we got last year. But let's just compare Google versus SPY. So we see Google gross margins, right, are 54%. SPY is 32%. So what gives? I mean, Google right there, is a more profitable company. Net margins in Google are 22% versus SPY 8%. Operating margins in Google 23%, SPY 12%. So I'm paying a relatively same price, but on the surface here, Google looks like a more profitable company, right? We have to keep in mind SPY is more diversified, so there's probably less risk to the downside of bankruptcy and stuff. But let's just, for now, keep everything the same, right? When we try to initially look at the benchmarks, let's keep everything the same and then compensate. So that's what this is telling me, that Google does much better than SPY as far as for every dollar in sales they do. For example, Google here, they have 54 cents left over as profit. So it only costs them 46 cents to make that product that they sell for $1. They have 54 cents left over. In SPY, they only have 32 cents left over for every dollar in sale. Okay. Then for the operating margin, obviously it's not only your input costs, you have to subtract, your administrative costs, marketing, sales and stuff. So after taking that out, we see Google has 23 cents left in profit versus SPY 12 cents. So bigger cushion for sure. And then net income, you see Google 22 cents left in profit, SPY 8 cents. So big right there, just a big difference right there. But what about growth? Maybe maybe SPY is growing a lot faster than Google. So let's take a look at that. So look, I'm not projecting it. I'm just looking right now at the historical growth. So we see last year, Google's revenues increased by 13%. For the same period, SPY's declined by 1%. Right? So Google actually sold 13% more last year than the previous year. SPY sold in net sales was 1% lower than the previous year. Over a 3-year period, Google averaged per year 18% growth, SPY 5%. This is in revenue. In the 5-year period, Google's 19% growth on average versus SPY 4%. So their profit margins and growth, I'm using 2 benchmarks, seeing, well, if I'm paying the same amount for the same amount of earnings, where am I getting a better deal, right? So here, Google looks like a better deal on growth and profit margins. Operating income, we just talked about that. From the previous year, Google's operating income grew by 15%. SPY's down 14%. 3-year average, Google grew annually by 13% on average, SPY 1%. 5-year average, Google grew their earnings by operating income by 16% per year versus SPY 2%. So there we go. So now we're painting a picture that, their profits and their growth, Google looks better, but for the price we're paying, we're getting the same amount of trailing earnings. Is that, well, so far, let me know if you have any questions on that.
Yeah, there was one question, and it was about, I don't know, 4 or 5 minutes ago. He was asking, and I didn't see where standard deviation was even in the spot, but he's asking, how does standard deviation apply to these financial averages you're showing him?
So I'm going to go back to the SPY, and that's a good question too.
All right.
Let's skip that. So
that was John Miller who asked that.
Yeah, and that's a good question, because I did have it in there. I just skipped it. But what does this mean right over here? So this is what we're looking at. Right now, the PE, price to earnings, is 35.89. 3-year average of this PE is 27.98. But that's an average, so it fluctuates, just like the price of apples, right? If you go and you buy an apple, 1 week it's 75 cents, then it's 70 cents, 80 cents. So it's going to fluctuate around an average. So in finance, we say it should be within 1 standard deviation. So 1 standard deviation is 33% of the prices should be away from the average, right? That's a 1 standard deviation move. So once you start going above 1 standard deviation, here we're 1.8, you're getting already outside that anticipated, range. You're starting to get it already on the high end, right? The 1.8, 2 standard deviation, 3 standard deviations. You're starting to get outside that expected range. So whenever you're within 1 standard deviation, it's basically just fluctuating around the average where you would expect. Just like apples, you don't expect them to be exactly 75 cents every time you go to the store, but if it's but it's going to be 80 cents, 60 cents, 65 cents. So it's within that range. Okay, that's why we look at that 1 standard deviation. So it's taking a look at the average and how much is a standard deviation, 1 standard deviation move. Is that helpful? Let me know if there.
Yeah, that's super helpful. Nick on YouTube is asking, are these fundamentals versus the peers, is any of this data? I know a lot of this fundamental stuff is still being built by you and the development team.
Yeah.
Is it downloadable?
What I'm looking at right now, some of this is downloadable, I think. Some of it is. I think actually you get a breakdown down here. So these are, we're using aggregate numbers, but so these are the statistics, but down here, these are the S&P 500 stocks, like Apple, Microsoft, Google, right? These are the S&P 500 stocks, total revenue, cost of revenue, gross profit. So I think you could just download this down here. I haven't downloaded this actually from here. I use a different spreadsheet for my analysis, so I haven't tried this download yet.
All right.
Yeah. But again, we're still building. So this will look a lot different probably a week or 2 weeks from now, because I'm already looking at my internal, and there's going to be enhancements coming up.
I see right now there's a download now button in the right-hand corner. I didn't notice that.
Yeah, I'm not sure. Yeah, I haven't used this download button yet, so I'm not sure what it downloads. If it's these tables, I believe though it's the raw data down here.
Again, these are new features that Dimitri's been working super hard on to bring to the Market Chameleon community. So test them out. If you find things that don't seem to match up or aren't working, just email support at Market Chameleon, and we work hard to make all these pages very usable and user friendly.
Right. Yeah. And you'll see, like, once you start using it, you're going to start noticing all of a sudden, because these terms are going to become commonplace to you, when you get like a hedge fund manager, or you're going to get, even like watching Shark Tank, or you're going to, or you're going to watch, on CNBC, even like Warren Buffett, he'll talk about his own benchmarks. Like, he's famous for the, GDP. What is that? The total market cap of the Russell versus the GDP, right? So instead of the market cap versus the earnings, he'll do it versus the GDP. But he uses that also to see how far away the market is overvalued or undervalued. But even though these terms are used a lot, because a lot of times most places are just not referencing them, that they become foreign. But you should start getting used to seeing them when you hear like hedge fund managers and so forth talk.
Yeah, just let the chameleons know we're getting a question why on their screen you have more tabs you can go to on the fundamentals. It's because a lot of these things are still being worked out. They're only for Dimitri and the development team right now.
Yeah, so you're looking at my internal test screen.
So a lot of those features will be coming out as soon as they've passed.
They'll be rolled out, right?
Yeah.
Right. They still need to be tested and cleaned up when there's exceptions. There's always like exceptions and bugs in there that we're still working on, but they will be pushed out at some point. Great. So before I move on to the options, we took a look at it from two perspectives. One, we compared the valuation versus where it has been historically, and another, we compared two different financial assets, right, against each other. That's two different ways that you could start analyzing and now picking out what are good deals, what are bad deals, what should I stay away from, where is the price doesn't make sense to me, because ultimately when you buy it, what did you get for it, right? That's what you got to start thinking. What am I getting for this? If I'm buying a stock and all it does is have debt and no money, and here, I'll show you. Let me see if I could find one actually. Let's do. Want me show you one really quickly? Well,
sure.
Let's do here's like and this one, it might be not completely fair, because biotech stocks, they work differently. They're not like, sometimes they don't make a stream of money, but they'll create something that may make a stream of money. But let's just take a look at one. I'll take here. I think I had someone question this, LIXT. And I'll just show you, like, here's a biotech stock, $3.70. I don't know anything about it. Okay, so you go read it. It might cure cancer. I'm just doing this for demonstration purposes. But if I took a look at this and I'm like, okay, what am I getting for this? Right? I might want to come here and say, okay, what is their income statement? And I see no revenue, right? So I'm not getting any revenue right now, right? So this is what I'm buying into. So I have to feel confident, right? Because If I'm just most people, they'll just buy, oh, it's up 2.2%, time to get in. But this is what you're getting right now. No revenue, no profits. You're getting about, operating expenses between 300,000, went up to 1 million. You got administrative costs, 400,000, 200,000. So this is per quarter. This is what you're buying, right? Operating income minus 2,300,000. And how much money did they have? So I'm just running it off my head. I don't know what does this look like to you? Like they're losing like 300,000 a quarter on average. So how much cash did they have? Like how long can this go on for? So the last quarter, and take a look. So here, the last quarter, they had ending cash balance 1.1 million. So what is their runway? I don't know, like
a year,
4 or 5 months. Who knows? Right, unless they raise more capital. But you got to beware what you're buying, when you're getting into it, because you're looking at a stock, you're looking at a symbol, but what are you getting into is important, right? Because you got here, I don't know, maybe 5-month runway before they have to, issue more stock, or maybe maybe they'll come up with some invention. I don't know, but I'm just showing you kind of from that perspective.
Well, it's been around quite a few years and they haven't come up with that invention yet. So,
yeah. So, let's take a look here. What happened? So here, changing cash. So it's down, down, down. Let's see. So this is a change in cash flow, right? So we know they're not making it from selling anything. So here, 1.2 million. So they received $1.2 million in cash down here, 2017. What did they do? Here, they sold $1.5 million worth of stock. So they're diluting the investors, right? So you could come here and you could see where they're getting their cash from. 3.9 million, right? Their cash went up. What did they do? Financing. There you go. So they looks like they issued more stock, right? So as you keep going further and further, you're just getting diluted more and more. And who knows if they'll buy, as long as there are people to sell stock to, I guess it'll continue going, but eventually it might stop, right? Eventually it might just, or they'll say our product is not working. Anyway, just wanted to show you really quickly, price valuation, very important. Let me come back to, if there are no questions here, we could just go to some other benchmarks now in options.
Right.
That's what we were talking about. So let's take a look here. I'm going to take a look at option benchmarks. Again, in options, we also need to kind of benchmark, well, what is it going to cost us? What is a strategy? Because in options, there are different strategies, right? I could buy just a call, I could buy a put or sell it, or I could buy a straddle or sell a straddle, or I could do a bull call spread or bear call spread, all these different strategies, like up here, there are a list of a bunch of different strategies. So the first question is, well, how much is it going to cost me in relative terms? And how does that compare to historical? So let's start out with the straddle. Or maybe I'll even do a simpler one. Let's just do a call or a put. So a long call, right? So if I buy an at the money call with 30 days to maturity, I got to put in perspective, I'm paying a price, but, what am I getting for it? So it's going to cost me 2% of the spot price. So basically, if SPY was 100, that means that an at the money call would cost me $2. If SPY is 200, it would cost me $4. So I'm paying 2% of the spot price. How does that compare to the 52-week average? 2.9%. So right now, if I'm feeling bullish and I think it's going to go up, I'm actually getting a pretty good deal compared to the 52-week average, right? It's like buying the apples below. If you really want an apple, and usually they're 75 cents, well, you could get it for 60 cents or 55 cents. That's a great deal. So that's how one benchmark you could compare just buying a call, right? And it's a quick way of doing it. Also, we could go to the longer term and say, well, what about a call that's 5% out of the money? So that's an at the money call. But what if we wanted to do an upside call that's 5% above today's spot price? So we could do that as well. So we see here, it'll cost us 0.2% of the spot price, right? That's how much the premium is versus 52-week average of 0.8%. So we see now that's also at a discount versus 52-week average. So the point here is I could really quickly assess where the calls are and have my benchmarks to see if it's high or low in relative terms to the historicals. That's why we're benchmarking. So quickly, I could jump to it and make a quick decision. Okay, so we could do that for the 60-day at the money, 60-day 5% out of the money, and so forth. So that's one way why benchmarks are so important, because it's a much faster way to go in there, look at a strategy, and make a quick valuation if you want to pursue it further or not. All right, so that's a long call. Straddle, same thing. That's buying the call at the money, buying the put at the money. Well, how much would that cost? 4%. So we know that the stock has to move by 4% or more if we're buying it for us to be profitable, right? By more than 4%. Historically, it would cost us 5.8%. So if we think that in the next 30 days, SPY is due for a good move, and we think it's going to be more than 4%, then that straddle is looking pretty good, especially it's below its 52-week average. So even if it just gets back to its 52-week average, look at that 1.8% difference, right? So right now, people don't feel like it will, so you're getting a discount for it.
We just got a question from Wayne relative to these benchmarks. He's asking, is it a fairly good correlation with the benchmark and the IV rank?
Well, yeah. So the IV itself is another way to translate the options. So yes, the IV is correct. The IV goes up, the cost of it will go up, and the IV goes down, the cost of it will go down. But this is kind of already putting it in terms that I think it's more understandable, right? Because IV to people is people say they know IV, but I doubt most people actually took the time to derive the implied volatility using the Black-Scholes or binomial to really understand it. Okay, that's why I'm putting it already in simpler terms as premium to stock price. Because when we're looking at implied volatility, you're accepting certain assumptions within the implied volatility that I think most people don't actually trade that way, and that's that you're trading delta neutral and you're trying to trade the volatility of the stock, the average daily volatility. Okay, that's what it's assuming, and then you could start using the implied volatility. You'll know how to use it more appropriately. But I doubt most people really took the time to plug it in and figure out how that binomial or Black-Scholes model works. So again, that's why this benchmark is a little bit easier, because I think most people will trade options from the perspective of they're going to either buy and hold them or sell them and hold them, but they do very little as far as delta hedging. Hopefully that helps, but there is a correlation. Yes.
There's no way to change that 52-week average. Someone is asking, they would like to make it a shorter term to look at the differences than the 52-week.
So not from here. There's a way. Let me just see really quickly. So when you come in here and you just take a look at, I'm going to put in a straddle. Let me see if I can do this. So if I look at a straddle 387, I'm just going to buy this put, buy this call. So I'm going to create that straddle, right? I'm buying the put and buying the call at the money on this expiration, 10 days to go, March 8th expiration. So this is what the payout diagram looks like. But I'm going to go here to the IV Theo. Yes. So this IV Theo actually goes day by day and tells you where theoretically, based on historical IVs, we're converting it to the value. So you could see here day by day where this straddle would have been priced, like this.
So when we were talking IV rank, I mean, it's the IVs right there. I mean, someone can see it, you know.
Yeah, you could see exactly. You could see right here as well, day by day. So this is like saying, so today, what happened today? Implied volatility was up 9%. So this straddle costs more money today, right? The straddle is more money. So when we come down here, we'll say, well, what did it cost? What would have it cost us on February 19th if we use February 19th implied vols? So it would cost us $9.38. Today it's $10.53. Right, here's the historical average. What about on February 18th? We see if we use February 18th implied vols, it would cost us $9.55. February 17th, $8.86. So you could see here, at least in the last, what is that, 10 days, I think I have here, you know, it's ranged between as low as 886, size 997. Today, vol spike, we're at 1053. So if implied vols come back in, you could kind of get a sense of like how far away we are just in the last 10 days. And then you could just keep going back this way. So even here, look, implied vols were higher in January. It was as high as 16. So you could get a sense of how much it fluctuated day to day. So this is keeping a benchmark at the money using the IV. Is that helpful?
Yeah. Someone, the same person who was asking about the IV rank, he's asking, is that info the same found on the historical chart? I'm not exactly sure what he means by historical chart. Would you know?
So no. So let me explain to you the implied volatility. I just had this question, and I get this question a lot, but I just had this question today where somebody is trying to make me explain to him an IV. And here's the question. Why doesn't your IV, right? Why doesn't your IV match up with something he's seen on his brokerage screen? Okay. Why doesn't that match up? Okay. So here's the reason why when you're looking at implied volatility, and you might be looking at your broker screen and you're thinking, well, if I see 15 here, I need to see 15 on my broker screen. And here's the reason why. Because when we look at an implied volatility, 30-day IV, this is the chart, 30-day IV. The stock itself, SPY, doesn't have an implied volatility. There's no such thing as SPY implied volatility. Implied volatility is derived from option prices, right? The options have an implied volatility, not the stock. So since the options have implied volatility, there are lots of different options. You know, there's options in March 8th, there's options in March 15th, February 22nd, there are options on this strike, and then there's options on this strike, there's options in this put, there's options in this call. Every option has its own implied volatility. Okay, remember that. That's why, that's number one. When you're referencing something, there's no one implied volatility. It's not like a stock that trades. You're deriving something from an option price. The other thing is that implied volatility is use a method to calculate implied volatility. So it's not a formula, it's a method. So what do you mean by that, Dimitri? You know, I'll get that. So when you look at the option pricing model, it's a model, it's not a formula. Option pricing model, there are inputs in there, and those inputs are assumptions. For example, Well, what do you think the interest rates will be in the next 10 days? This one, what do you think the dividend will be? How are you decaying the option, right? So the option has a time decay. Are you decaying it linearly, like once an hour, once a minute, once every half a day? How are you treating? How are you treating? Are you using calendar days or trading days? Are you compensating? What are you doing for holidays? What do you do when you're referencing prices? What do you do when there's a wide market, or a cross market? So all these things are in your model. So our methodology that we built up for, over many years of trading might be much different than somebody just entering in things Black Scholes and we don't know what they're doing. Okay, so that's one reason that the implied volatilities will not match up. The other reason is that this implied volatility, like I said, there's no one implied volatility, but there is kind of a industry standard to reference implied volatility, and that's taking a 30-day constant maturity. So this is 10 days out, right? But if we did 30-day constant maturity at the money option, and to do that, we have to kind of derive that value by looking at two expirations that straddle 30 days. We take a weighted average between the strikes that straddle the at the money. And also there's a methodology there, because how much weight do you give to the put, how much to the call, how much weight do you give to a wide market, to a tight market? But you come up with a 30-day IV. Okay, that's what you're seeing in here, right? So this is the chart of the 30-day IV, 30-day constant maturity, which is like the VIX, right? The VIX is a 30-day constant maturity. It's a formula. It has a methodology. It tells you what it does. Like if there's no bid in the strike, or if there's a penny bid, or if it's wide, it tells you there's a methodology to it. So similar to the VIX, we use a 30-day IV. So that's just a general reference. Why it's not the same as a strategy is because these strategies are not all 30-day IV, right? If I'm buying a call spread or an out of the money call or 60 days out, all those have their own benchmarks, because those options are different. They have a different maturity, they have different strikes, and a different combination, right? So that's why it's not, those benchmarks are not this. This is a benchmark too. This is a benchmark for the 30-day IV, but the strategy benchmarks are different. That's a combination. That's what makes this unique, because well, the 30-day IV is not really telling me if I want to do a double bull spread 60 days out. The 30-day IV at that point is almost useless, right? Because that's only telling you what a 30-day constant maturity is. 60 days out, we could be looking at something completely different. And if we're doing buying and selling, then we're looking at a completely different strategy. So you would have to use that benchmark instead of the 30 IV. Hopefully that helps.
Yeah, that is helpful. Mike from Tyler, Texas, D, is asking about the benchmarks relative to trading cards. Is the benchmark data taken into the when, let's say, a straddle shows up on a trading card? Is it looking at benchmark data when it's?
Yeah, that is using the historical. So that is the benchmark, right? So that is even getting closer. It's taking even more stuff into account. So that the trade card is even taking. It's like similar to this benchmark, but it's even taking more things into account above it. But yes, so he's talking about. So this would be converting it market price. That's your theoretical value, which is your average price. That's using the historical data. That's the edge, and it tells you a historical win rate. So yeah, it actually goes in there and says, well, this is a long call. How far away is it from the spot price? How many days left to expiration? Are there earnings? Are there no earnings? How high is the implied volatility? So it actually takes it further. But yes.
Great. Hopefully that helps, Mike.
If there's no more questions,
What, an
Hopefully
hour?
that was, yeah, we went for an hour. So hopefully that's good. And we'll talk more about it. But I did just wanted to kind of first lay the groundwork for.
I'm just wondering how the puts in the strategy benchmark SPY, how do they look right now?
So let's take a look at there.
We'll end on the puts in SPY.
So let me take a look at the put spread or just the put.
Just the puts. I'm wondering.
So here's a put that's at the money, right? So that's trading 2% versus 52-week average of 2.9%. By the way, the trade cards are looking further out than just 1 year. I think they're using like 6 years of data, but this is looking at 1 year. But let's take an out of the money put. So out of the money put, 5% out of the money right now costs you a little bit less than 1% premium relative to the spot price. 52-week average 1.6%. So at least in the last 52 weeks, it looks relatively cheaper.
Very cool. Thanks for that hour, D. That was very, very useful. Any parting words for the chameleons?
Thank you for joining us. I think that's like the third time I'm doing something today, but thank you for joining us. Stay safe out there.
Yeah, for those who don't know, we do a live morning show every morning on YouTube, 9 a.m. Take all questions. D always shows something useful on Market Chameleon. Make sure if you haven't subscribed to the YouTube channel, make sure you subscribe. That alerts you to any new videos. Dimitri's also publishing videos. So there's a lot of stuff going on. It makes it worthwhile being a subscriber to the YouTube channel. All right, D. Great job.
Will.
Thanks, buddy.
Thanks, everyone.
All right, everyone have a good night. We'll see you.